Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Yesterday, Domino's Pizza announced its full-year results, showing strong growth in the local market, but some of the key overseas markets are underperforming. Domino's was a share market darling during the pandemic, trading above $160. It's now sitting closer to $31 as the company grapples with changing eating habits and a challenging overseas expansion. This earnings season, we're working with the team at Ausbiz to bring you interviews with the leaders of some of Australia's biggest companies. Ausbiz is Australia's leading provider of live and on-demand video of the latest news in Australian business, markets, economy, and startups. Sign up at ausbiz.com.au. It's free. Juliette Saly spoke with Domino's Chief Executive Don Meij about the results from the overseas markets facing the most pressure to competition from the fast-growing Guzman y Gomez and even the impact of weight loss drugs like Ozempic on the outlook for the business.
Thanks so much for joining us, Don. So you did see network sales up 4.6%. Just talk us through some of the highlights in your own words.
Yeah, so the core driver of our business was still our digital online sales, which were up 7.5%. One of the things we did this year is we restructured the business. We set up what we call centers of expertise, trying to leverage our global network. One of those examples is our digital center of expertise, and they perform very, very well. So, using the global media platforms and then using our global online ordering platform and coupling those, passing that back to the local teams where we have country management, and then those country management are executing against product and the brand itself in market, so that the brand, whether it's French or German or Japanese or Australian, that has the look and feel that's relevant to that market. Specifically in that, the great performance came from a record profit in Australia and New Zealand, where we had our best same-store sales in 7 years. We had strong performance in Germany, strong performance in our Singapore business, be it small, and we had a really good return to good growth in our Benelux business in the last quarter. The two business units that we need to perform better in is in Japan and in France, and what we've shared with shareholders today is our plan of how we plan to get back to growth in both those two businesses, and they're scalable businesses. They're already at 1,400 of our 3,800 stores, so we need those businesses to start contributing to our profit and our sales.
Yeah, how crucial is that, Don, given you have had a shaky start to full year 25 with same-store sales lower than you were anticipating?
Yeah, that's one of the interesting things about reporting 7 weeks out of your normal 52 weeks in a year is that, we, in one period of 7 weeks, we might be trying to hose down expectations. We might have had a blip that was unique. For example, this time last year, the Matilda's performance in the Australian New Zealand business, we had all these record days that came out of nowhere because the whole of Australia was just captured by the getting on television and watching the Australian team perform so well. That was a one-off occasion, and now we're rolling that. Earlier this year, we said, look, these numbers in Japan that we just reported for the first 7 weeks, please know that they are inflated by a unique promotion and performance. That is not so in some cases we're doing that. And then in other cases like now we're saying, look, this 7 weeks does not reflect the core performance of the business. We still expect to return to 3 to 6% same-store sales growth. We do need France and Japan to contribute to those. Both markets are moving into higher media spends coming into the second quarter and beyond, and have relaunch of the brand, in particular in France, and change to some of our pricing models, less discounting in Japan, which didn't work in a low-frequency market, and focusing more on unique products to Domino's, and then putting good media behind that to then activate the customer.
Is there a deadline if you don't see a turnaround in the French and Japanese businesses?
I think it's very dangerous for any leader to just go out there and put those sort of expectations on a team. What we're really looking for is forward momentum in actions. And so, this business has 4 core earners today, and it should be a 5th one when France comes on. But if you look at the history of this business, it's made all of its profit out of Australia, New Zealand, the Benelux, Germany, and Japan. And out of those 4 units today, it's only Japan that's been underperforming in recent times. We have great expectations that Japan will return, and then France should be adding to that. Now, markets like Singapore and Malaysia and Taiwan do contribute to the business, but they're not the big 4 core earners. Right now, 3 of the 4 are firing, looking for number 4 with Japan to kick in and France to then add to that again.
You did mention Malaysia, though, and that was affected by some geopolitical issues. Just tell us more broadly how the Asian business is faring.
Yeah, so we roll the events, the geopolitical events, by October. So then we have a like-for-like year where we're not seeing the effects of those global political events get worse. In fact, we've actually seen our performance improve against that. So when we roll those, we expect to be back into positive performance in the Malaysian business. Fortunately, when we acquired the Malaysia, Singapore, Cambodia business, we had some really large structural plans we put in place, which then delivered, we highlighted today, 21% same-store sales growth in the Singapore business, putting in our new tech stack, moving to making dough in store, cutting vegetables in store. So important to have those sort of fresh ingredients, both from an ESG point of view, but from a quality and a margin point of view, put into store. Because we did that, it also safety netted our profitability in Malaysia, in that we didn't get quite the impact we would have had from the deleverage of sales because of all of those initiatives. So we're looking forward to rolling in October, and no one can really see into a crystal ball of what might happen in those geopolitical things. But from a like-for-like point of view, we start rolling off that in October, specific for Malaysia. Taiwan's actually had really good growth the last 6 months, and then Japan needs to add.
What about your Australia business? You mentioned the impact of the Matilda's effect last year, but you have said yourself the fastest growth is the single eater. How are you faring amongst your competitors and the aggressive growth of Guzman y Gomez?
Yeah, so Domino's historically, and Australia is no exception. So every second pizza, in fact, it's now grown to 53% market share. We took 2 more extra market share points this year. So we're the fastest growth in pizza, and in some quarters, the fastest growth by customer count in QSR of the major QSR, which we see as our direct competition. And so, when we look at our business historically, for all of that success, we've predominantly been a dinner and shared meal occasion. So to get growth in lunch, snacking, which is in afternoon, early mornings, and late night, we've pursued Melts, the My Domino's box, and we've got more products coming. We just launched Pizza Dogs only earlier this week. We've also launched them a month ago in the Netherlands, which is a new consumer, a smaller price point. Mum after school, a $3 pizza dog, great protein fix straight after school, and still indulgent and suits all of the Domino's, the way we like to think of how we design our product. We, as a result of that, were the fastest growth lunch brand out of all the major QSRs in Australia in the last year, fastest growth in delivery over the full year, and we had great growth in snacking performance in those areas. So we really overperformed in areas we haven't typically got a consumer, hence having our strongest sales in 7 years, even though it's our largest business.
So talking of those cost points, and of course for lower consumers as well, consumer wallets, particularly amongst the high cost of living, what's the plan there to try and lure more customers in?
Yeah, so we've got a very exciting product pipeline. So when we came out of COVID, I give our performance in the first year of inflation, quite terrible. I've been in this business now 37 years, 35 at that point, and the inflation we saw in Europe, with not only all of the effects of coming out of COVID and the way governments behaved and the political events that happen around the world, for example, the invasion in Ukraine. We saw some really incredible inflation. At one point in Germany, inflation for us was 21% in one quarter, so quite significant. We didn't know how to respond, and we had to rebuild our muscle memory and product development. We'd been such a digitally driven business the decade before. In COVID, we were just trying to keep up with our supply chains. So getting back investment in our chefs, investment in our research and development, and now you're seeing the benefits of that, and you're going to see that accelerate into this year, where we've got a lot of new exciting products. Once again, mostly built around new segmentation. So we highlight that on slide 3 in our investor deck today. Lunch, snacking, but there's other areas. You'll see on their drinks. You would never have thought of Domino's really as a drink purveyor. A few years ago, we launched premium thick shakes. They're some of our highest performing products in Japan, the Netherlands, Belgium, Germany for an NPS score. Really good margin, designed to be delivered thick shake, minus 14 degrees Celsius, all natural, quite indulgent product. And so that's given us an excitement into the booming business where many consumers around the world are changing their dietary behavior, whether that's through Wegovy, Ozempic, or just through wanting to eat more frequent, smaller meals. And we're building those smaller meals for consumers that are very high protein based as well, which is also a big key driver when someone's indulging.
I was going to say, you worried about the impact of those weight loss drugs on your future bottom line?
Not at all. I've been here 37 years, and I can't remember how many of those sort of events that we've faced. But what do you monitor with the kinds of people that are now moving into that sort of health choice? Smaller meals and needing to put more protein into those meals. That's very much the core focus of our business. Our products, every one of them that are launching has that core in mind, including some of those consumers also move to using liquid drinks as a meal solution. And we're also pioneering and working really hard and designed to be delivered drinks. So you can expect a lot of new innovation for Domino's. By the way, mainly chasing an existing customer that already exists. But the bonus is that it also is individuals that choose that lifestyle choice still want to treat themselves, and Domino's providing a treat that suits their meal occasion.
Well, Don, as well, let's talk about your dividend payments. So 54.4 cents per share interim unfranked. What is the potential growth that you are seeing for full year 25 dividends?
Yeah, so it's obviously always based on earnings growth, and from the franking perspective, it's where those earnings are made. We are a very proud Australian company, and as a result, we like to bring our profits home and pay Australian tax, and that's when we get our franking credits. Unfortunately, because we've had some restructuring costs, we haven't paid the tax that we typically pay in years because of the write-downs, but we plan to get straight back into profitability, a lot less need for restructuring costs, and therefore, return to franking to our dividends. And with earnings, currently we have an 80% payout ratio. We've historically ranged between 70 and 80%, and there's no indication that would change. So earnings, Australian-based, and how we repatriate those earnings, that is, because of the IP that we ship all over the world with all of our technology, our product innovation, and so on. We're a very proud Australian company.
And in terms of when you might see shareholders kind of come back and show you some love, I know you can't control the market, but your thoughts on whether or not you're sitting below fair value at the moment?
Yeah, look, we never comment on share price, but my job and my team's job, the leadership team, is to execute against growth. We need to return back to a growth company that shareholders expect to get to the 7,100 stores and beyond. And that means that we need each of our business units to get back to the sort of growth you've seen in Australia, New Zealand, Germany, Benelux. We're seeing out of Singapore and Taiwan. But we need the other big engines too, of France and Japan, to contribute to that growth. When we wind up store growth again, so you can imagine when the earnings were the way they were the last 24 months, we weren't opening the store counts, which means that we didn't have a pipeline of sites. Well, Germany, the Benelux, Australia, New Zealand, Taiwan, even Malaysia right now, we're out actively pursuing sites. Now, that happens pretty quickly with growth in Malaysia, Australia, New Zealand. When Japan comes back online, it'll happen quickly in Japan. The European pipeline typically takes 9 to 18 months to fill. It's a much more structural model that we have to work through there. So the sites we're finding today will open in 9 to 18 months, and Germany and the Benelux are already going to contribute to that. And I can't wait for France to add to that as well.
That was Domino's CEO Don Meij speaking to Juliette Saly from Ausbiz. Sign up at ausbiz.com.au. It's free. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.